All right. Hey there. Welcome to the Legacy Wealth Podcast. Today I have on the show is Matt King. And I know Matt King from GoBundance. He's the CEO of GoBundance, and we're bringing him here on the show today to help us understand investing from the LP perspective. So welcome to the show, Matt.
Yeah, thanks, Pascal. And thanks for what you're doing, man. I think there needs to be more education put out for LPs when making investments. I think it's like the wild, wild west right now. And so I think educating people and teaching them what to look for and what to pay attention to is super important. So I applaud you for that. I think it's really, really needed in the space right now.
Thanks, man. Yeah, we're all learning in on this journey together. So let's kind of start out with give us your background, your story related to how you eventually started investing in funds.
Yeah, so I was just born and raised in a small town in Wisconsin, man. I thought LPs was a type of propane or natural gas. Like when I was growing up, I had no idea it meant limited partner. I was fortunate enough to move to Austin, Texas about 9 years ago to work for David Osborne, whose family office I now run and oversee in addition to being the CEO of GoBundance. And the way I was exposed to investing was just through trial. David is a serial entrepreneur and a serial investor. And so I've seen everything from CPG or consumer product goods stuff to different debt structures to LP funds to GP funds. I've seen everything, and I've just really gotten a crash course in what to do through being a part of his family office. Growing up, I never would have thought of myself as an investor in this vein. I didn't even know it was possible, candidly. I thought an investor was somebody that bought a house and rented it. To me, that was the definition of an investor. So I've really had to learn all of this by just getting in the trenches, rolling up my sleeves and seeing it firsthand. I never graduated from college. I dropped out to start my own business. So I'm not Harvard trained or MBA trained in underwriting deals and understanding structures. It's just school of hard knocks and just learning it by cutting my teeth, getting out on the streets and seeing deals and doing deals and comparing things, asking questions, being curious, and talking to the right people that have educated me along the way.
Yeah. So when it came to investing, did you first start investing your own funds? Did you invest on behalf of David Osborne? Yeah. It sounds like from David Osborne's perspective.
Yeah, I've been very fortunate to be able to invest, to watch him invest his funds and then transition into slowly investing his funds. And then as a byproduct of that, getting to invest mine too. So the journey started with me just looking over his shoulder and watching him deploy his capital and choose where to put money. And then it slowly evolved into me now being the driver. I mean, ultimately it's his world, so he's got final say so. But I do all the due diligence, I do all the underwriting, I bring the suggestions to him, and then make the decisions and just get his stamp and his blessing. And so I started off with his money, but I've always looked at his money as if it were my own. I think the problem a lot of people make when overseeing other people's funds is they don't have the same attachment to the outcome because it's not their money. And if you don't have attachment to the outcome and assume it's not your money, I think you start to run into some issues with just mismanagement and not paying attention to the details, which is the most important part in investing. So started with his money and him doing it. It led to his money and me doing it. And now it's, his money and my money and getting to do both of them, which is a pretty cool journey that I've been on.
Definitely. Okay, that's awesome. So that's a great little backstory there. Tell us about this one's a little bit nuanced because you've been working with David. Tell us about maybe your first fund. It wasn't your first fund because you were leveraging the experience of David, but talk to us about maybe the first fund that you were involved with and what that process was like, how you picked the deal, why that asset class.
Yeah. So really what from an LP perspective, kind of my beliefs have come full circle. I really suggest that people should only making LP investments if it's outside of their area of expertise. It stands for limited partner for a reason. And really the only time you want to be a limited partner is when it's not in your area of expertise. If I'm a doctor and I'm investing in some sort of a doctor medical device, if I can't create that own medical device, that's a great opportunity to be an LP in a fund that does those investments. If I'm a real estate developer, I probably have no business being an LP in other real estate developers' opportunities. If I can control the outcome and be the GP inside of a deal, the economics are in my favor. So the first time I was really exposed to an LP deal, it was in the tech space. So David is mostly real estate and we really understand real estate. So when we want exposure to different asset classes that we're not experts in, that's when we seek an LP position. And so I remember it was a tech fund based out of Austin, and it was focused on primarily like tech companies based in Central Texas. And we wanted exposure to the space. We didn't really have as much exposure to technology 9 years ago as we thought we needed. And, hindsight, we got the exposure we wanted. We should have just gotten out about a year ago because we would have timed the market perfectly. But that's impossible to do because when you're an LP in a fund, you don't control the duration. You're just a passive participant in the deal. So I always look at the sponsor first and want to really understand who is the person we're investing in. You're investing in an opportunity, you're investing in an asset class, but at the end of the day, the who is the most important thing. If that person has a track record of success across many industries, across many markets, across many cycles, it gives me a really good vote of confidence. If that person is doing their first ever real estate fund and their main job is being a doctor, I'm probably pretty nervous to be an LP in that deal. Because remember, being an LP, you're passive capital. And so basically what somebody is saying is I don't have enough equity to put in this deal by myself. And so I need other people's money and I need to pay them a return for using their money as a way to get this deal done. So if I'm, there's a saying like teaching somebody how to shave, but on your face. So I don't want somebody to learn how to shave on my face. So I don't want to be an LP in a deal where it's somebody's first deal because my capital is at risk, right? Like they might have a little bit of skin in the game, but generally my capital is at risk. So when we first made our investment, we were a small chunk of a very large tech fund. It was the second fund the guy has done. He had a track record of success. He had really good founders around him on his board. He had really good companies co-investing like Sequoia and some other big names co-investing inside of the fund. And so we started to see all of these signs of this is the right deal for us because it was de-risked a lot. So that was really like the first forte into deals. Now, fast forward 9 years, I've seen tech, I've seen real estate, I've seen single family, multifamily development, CPG, medical, space, like you name it. I've had the opportunity to see many of the deals. And the question I'm always asking myself is who is the sponsor and what is their track record? Like I want to know that they have a track record of success and they have an unfair advantage in the space that I cannot get in the space unless I am with them. And not space isn't going to the moon, space is in the asset class. So if it's single family homes, for instance, investing in our fund that David runs, you have an unfair advantage. He owns the 8th largest residential real estate brokerage in the United States with 5,000 agents across North Texas, New Mexico, and Memphis. Like we have an unfair advantage. We know the market. We see the market. We have boots on the ground across the country. If you came to us and said, hey, I want to invest in your oil and gas fund, we don't know the market. We're not experts in the space and we don't have an unfair advantage. But if we invest in Brian Sheffield's fund, Formentera, his grandfather grew up in Midland. They own thousands of acres. He grew up in the oil fields. He knows everybody that there is to know in West Texas. And now we have an unfair advantage because of investing in his fund. We get access to all of his resources, all of his deals. And so that makes us feel comfortable about going into his deal as an LP.
Yeah, it makes sense. So when you're investing, do you have a cash flow goal in mind? Do you have an equity growth goal? Are you saying, hey, I'm investing in this for primarily the tax benefit? Like, what is how do you figure out first what your investment objective is, and then are you saying like, oh, I'm interested in equity growth only, so like don't even care about the cash flow portion of this deal, or I'm going to focus more on things that don't return any capital until the end of the investment? How do you think about that?
It depends, man. So I think you need to look at your capital as in buckets of capital. I think some of it needs to be growth only. I think some of it needs to be growth plus income. And then I think some of it needs to be income only. And you look at it as if it's growth only, it's probably got a higher downside potential than if it's cash flow only. So things that have a huge growth potential probably also have a huge downside potential. So I would say about 5 to 10% of our portfolio is growth only. It's like investing in tech, hoping it gets to the moon. And if it doesn't, we probably lost our money. Now, the beauty of investing as an LP in tech funds is you get diverse exposure to multiple technologies. Rather than trying to pick the one winner out of all the possible winners in technology, you get to invest in a fund that hopefully is diversifying its assets across 10 or 15 different assets. And now you have some sort of downside protection because you have diversity across the portfolio and you don't need all of them to hit a home run. It would be great, but not likely. Then I think some of it needs to be some growth with a cash flow component. That's where, like, I would say you want about 50% of your portfolio or 40% of your portfolio. That's where, like, you have some opportunity for upside, but you have consistent cash flow along the way. This would be like multifamily that does some repositioning or rehab. This would look like a fix and flip type fund. Now is not a good time to invest in fix and flip, but opportunities that the cash flow day one is solid, but there's juice left in the deal if you can improve the product, increase the occupancy, improve the rent collections, etc. And then the main portion of your portfolio, that other 50%, should be cash flow only. This should be like the boring horizontal income, super safe. It's going to grow at 3 to 5% a year, but it's going to spit off a 7 to 10% distribution annually. And that's where you're like, that's your safe money. That's like, I can go to bed and know that I can rely on that check to keep coming in. I'm going to hopefully outpace inflation, which in this market, it's tough to do. But over the long term, I'm going to outpace inflation and I'm not going to lose that capital. I think you have to look at your capital like soldiers. When you have this army of soldiers, if you send them into a war that they can win, all of those soldiers can come back plus take the territory you sent them to take. If you send them into a war that you're going to lose some people, now whether or not you take that territory, you may have lost some of your soldiers along the way. And so you might not be able to generate the same amount of returns from your money as if you had all of those soldiers still today. So you kind of got to take your assets and put them into buckets and say, what is my risk exposure, which depends on, how big are your guts? And then most importantly, like, what is the tenure of your investment career? If you're 28 or 32 or 35, like us, you have a longer duration, so you can be a little bit riskier because you have time on your side. If you're 60 and you just sold KFC chicken and you got 50 million bucks, but you don't want to work anymore, I'd put all that money into a safe bucket because if I lose it all, I don't want to have to go back to work. So you kind of got to look at where you're at in life and what fits you. And then you've got to diversify across those three buckets to make sure that you have exposure to everything, but you protect your downside and don't cap your upside to a place you feel comfortable.
Give me an idea of like how much you've helped deploy with David and maybe with yourself, and help me understand, like, are you you're not, I'm assuming you're not investing in every deal that David is investing in. So first, maybe like, let's check that assumption. Yeah. But how do you go about picking which ones are you're participating with? Are you focusing more on cash flow? Are you more on equity? Are you kind of divvying it across all three like you just mentioned?
Yeah, so I've probably been a part of the deployment. I mean, if you look at our fund that we manage as well as and our debt funds as a part of that, we've probably deployed over 300 million in assets over the last 9 years. I'd say of David's capital alone, it's probably been 40 to 50 million. Now, capital recycles and stuff like that. So, but we've just seen a lot of deals. I mean, we've probably invested in 100, 150 deals since I've been with him. So I've seen a lot of opportunities. I've seen a lot of things. How do I deploy my capital is a great question. Obviously, I don't have as many soldiers in my military as he has in his military, for that analogy. So I have to be a little bit prudent about where I put my soldiers. I can't invest in every single thing he does because I just don't have that much capital. But I look at it the exact same way I just laid it out. I have some in the long run, home run, swing for the fences bucket, understanding that if it's a strikeout, it's a strikeout. I have some like trying to hit doubles or triples, but at least getting on base. And then I have some where it's just base hits and boring, but it's at least spitting off some cash flow. Given where I'm at, I'm 32. Given where I'm at in my age, I have probably about 15% in the home run bucket, about 20 to 30% in the super safe boring bucket, and then the rest is in the swing for the doubles or the triples, but have a little bit of downside protection too. Because I have a longer track to continue to make money because I'm only 32. Now, I don't want to work forever, but time generally is on your side. And the greatest determiner of how your wealth will compound is time. And so, like, I'm fortunate that I have time. If my parents were looking at making investments, they're in their 60s talking about retirement, I'd say, like, don't put anything in the swing for the fences buckets. Put everything in the safe bucket, but maybe 10%. Put that in the doubles and triples bucket, but super safe at the same time. So I kind of look at that way with my money. I'll sit down and talk to my wife about what we're doing and why. She's interested in it, but it's sort of a foreign language to her. And so she'll ask a lot of really good questions that, sometimes I can get frustrated because I just want to go fast, but it forces me to slow down and be like, yeah, that's a great question. Am I okay if we lose that 20 grand or 30 grand? Am I okay if we only make 10% on that 30 grand? Like, are we okay with this, or how is it going to look? And then the other thing we do is we always try to be conscious of like the tax consequences. So I always say this, like, I don't like paying taxes, but you only pay taxes when you're making money. So, I try to be conscious of like, am I putting it into vehicles that are tax advantaged? Not avoid tax altogether, because I haven't found a way to do that yet. If there is one long term, I'd be interested in it, but my gut tells me it doesn't exist. So I just look for things that are tax advantaged, and just try to make sense. Like if you invest in notes, for instance, depending on the vehicle you invest through, you can be exposed to UBTI, which is like an excess tax that you just don't want exposure to. So if you're investing in an asset class that has the UBTI, you want to make sure you invest through the right trust or 401k so that you can avoid that UBTI and you don't hinder your returns through, paying too much tax. So, all of those things I take into account. But at the end of the day, I look at the operator, I look at the opportunity, and then I look at my risk appetite and say, like, is it the right operator? If it's a yes, then I go, is it the right opportunity? Right now, if it was the right operator in real estate, I'd probably be like, I don't think now's a good time to do fix and flips. I know you have an amazing track record. You have a really unique advantage, but I don't think right now I want exposure to equity in single family residential real estate from a flipping perspective. So I would say right operator, wrong opportunity for me at this moment in time. Now, if it was oil and gas or different commodities and it was the right operator, I'd say right operator, right opportunity. Now, how much of my risk do I want to expose to this asset? And so that's sort of like the matrix I use, or the lens I look through when thinking about investing.
So what I'm hearing is you're building up cash from your cash cow, your job, whatever, and then you're starting to invest it into these deals. How are you finding how are you picking the asset class? So how do you decide, like, right now I want to invest in oil and gas versus multifamily? Is it like, I have opportunities come to my desk and then I evaluate the operator and then the opportunity, or do you come at it from all right, I from an asset allocation perspective, I want to put 20% of my money into oil and gas. Let me go look at oil and gas opportunities.
Yeah. So I'm a little bit more of a gunslinger than a calculated tactician when it comes to like how to deploy money. But I do think of it from an asset allocation perspective. And then I think from like what we're going through in this market or in this cycle, what do I want exposure to? In 2 years, my gut tells me we will have gone through some sort of a recession or correction in real estate. And 2 years from now might be a great time to get exposure back into real estate in a heavy way. So I might say, well, like, given that real estate values have just corrected 40%, let's say it's the doomsday and doomsdays and everybody's panicking and there's blood in the streets. Now all of a sudden I'll go, well, wow, like 3 years ago I could have bought that dollar for $1, but today I can buy it for 60 cents. Like, yeah, I want that dollar. That's a good advantage for me. But I also then think a little bit about, like, I don't want to put all my eggs in one basket. I think, like, in life, we oftentimes will end up putting all of our eggs in one basket, and then we become beholden to whatever that basket was. Whether it's a wealth manager, whether it's a house we live in, whether it's a community we grew up in, or whether it's a job, or whether it's an investment. Like, we kind of like are all-in type creatures, generally speaking, and so I try not to be all in with my capital. So I don't want 100% exposure to the stock market. So like the traditional thing is work really hard, put money in your 401k, work until you can retire, and then retire and live off of your 401k. But guess what? If you have exposure to the public markets and that's the only exposure you have, if the public markets are down 20% when you go to retire, guess what? Your retirement's worth 20% less than you thought it was. And that may change your ability to retire. I don't want to be beholden to one thing. So I want some exposure to the public markets, which is a game I'm not smart enough to understand. And it's played by professionals that I don't know how to bump elbows with. So I don't play it much because I think like the people in the bars in New York are manipulating the system and figuring out how to win in ways that I don't have an advantage, nor do I want an advantage. So I have a very small exposure to that. I'll have exposure to like Carnival Cruise Lines when in COVID, the book value of their ships was more than double the stock price of their stock. Like, yeah, that's an unfair advantage. That doesn't make any sense. They could liquidate their ships for more than what the company's worth. That I'll invest in that. That's an easy investment for me. But right now I don't have a bunch of exposure to the stock markets because A, I think, there's a bloodbath waiting to happen, and B, I just don't understand it. So I'm going to stay out of it. But then when it comes to like oil and gas, I'm like, I don't see oil and gas going anywhere. Yeah, I think Elon Musk and Tesla and battery powered things are changing the world, but I haven't seen a battery powered plane yet. And I'm sure it's coming. It's only a matter of time. But until they solve the problem of traveling without fuel, like oil and gas is still going to be a thing. Like it's powering ships, it's powering cars. Like that's a pretty safe, stable space for me to be in. So then when you look at during COVID, when gas was $1.60 or $1.80, but a year prior it was $4, you go, well, that's more than 50% on the dollar. Like I'll invest in oil and gas. So you kind of just look at where we're at in the market. You kind of look at the different opportunities and go, like, what do I feel comfortable with and what do I want exposure to make sure that my assets are allocated in a way that I feel comfortable, but I'm not beholden to one single asset class.
Yeah, and then I guess like so you mentioned you don't have that much exposure to stocks and stuff. Like what made that transition happen? Why are you so interested in funds over, something else?
Dude, nothing. The only thing that made that transition happen was the job I picked. So when I came to work for David, there was no 401k. It was like, you have the opportunity to invest alongside of me in deals. And I don't put money in the stock market. This was David. He's like, I don't put money in the stock market, so I'd be a false prophet if I set up a 401k for you. I'm like, well, that's cool. Like, let me learn about it. And so I just saw like this opportunity to like, I don't want to say manipulate, but control the outcome a little bit more. Like if I can be an active participant, even as an LP in the space and understand it better than I can if I invest in Tesla and I'm just beholden to whatever Elon Musk and his beautiful company do, I want to like stack the chips in my favor. And I can stack the chips in my favor if I have some influence and some understanding on the asset class. And so for me, that was much more interesting. I'm kind of a control freak. And so when you can have a little bit more control over your investments, like I have this belief, like nobody's going to care about my money as much as me and my family do. I don't care how incredible a wealth manager is. I don't care how nice of a human is. They're making a fee to manage my money, but they're getting paid that fee regardless of if my assets go up or if my assets go down. So I would rather invest my money with a GP who's put their money in the same deal as mine. And when I win, they win. And when I lose, they lose. Like that to me is exciting. So, I was just fortunate to never be exposed to the stock markets in the career path I was given and I've earned. And to me, it's just never been a possibility because again, I'm just not willing to learn that space.
That totally makes sense. So you've been harping a lot on the operator. Like, first and foremost, the deal could look great, but if you don't trust the operator, it doesn't matter. Give me an idea. What's your due diligence process look like? Is it hey, I go on a trip with this person, and if it doesn't feel good, then or is it like I ask these questions, I do background, like what does that process look like?
Yeah, so it depends on where the operator came from. If it came from like a trusted uncle who's invested with this operator for 15 years, I don't have to do much due diligence. I trust my uncle. He's put his money in there. He showed me the returns. I don't have to do a bunch of due diligence. If it's a random dude that emails me that I don't know who it is, yeah, I need to get on a phone with him. I need to see some sort of a background check. I need to talk to a reference and see what they've experienced, how long they've invested. Really what I want to see in a human is how do they manage adversity? If you talk to an investor that says like, I've never lost money, either A, they're full of shit, or B, they've never sold anything, so they haven't realized the loss, but they have something that's lost money. Like that's just fact. Like right. Warren Buffett says, like, you never lose money if you don't sell an asset. That's true. And I'm not going to argue with Warren Buffett. However, I still want to know when he's losing money on a deal, how does he manage through it? Does he ignore it and try to like pull the wool over the eyes of his investors? Or does he confront it head on and say, guys, I made a mistake. I thought See's Candy was going to do this and it did this instead. So here's how we're going to pivot and here's how we're going to reposition. Like, I want to see how a human manages through adversity because that to me tells me everything I need to know. Are they going to stand in the front of the room with their chest puffed out and saying, I made a mistake. Let me tell you how I'm going to fix it. And here's our plan. Or are they going to hide in the back of the room and be a victim of the markets and not answer my phone calls and not show up when things go wrong?
Do you have an example?
I have a lot of examples, but I'm not going to use them. I'm not going to use them.
Yeah. Okay. Fair. That's yeah.
But there's so many examples, man. Like there's so many. Like I can give you some examples. So there's some tech companies we've invested in, some tech funds. When things are going well, they call all the time, telling me about how great it's going. Like, hey, I got some really confidential news. You can't tell anybody. I'm like, well, you breached confidentiality by calling me, so it must not be that confidential. So they call me like, I got some really good news. You can't tell anybody, but hey, we just got this valuation, or we just got this offer. Or when SPACs were sexy, like, we think we're going to sell as a SPAC for 100x. Like, so you get all excited, but guess what? When tech goes from, $5 million to $2 million, they don't call. They don't return your calls as quickly. They're not quickly eager to call you and say like, yeah, we're down 50%. We just got an offer to sell at a loss. Stock price got hammered. Like, they're not eager to pick up the phone. So like, that to me tells me a lot about the operator. I'd have way more respect if the dude called me in good times and in bad and said, hey, we're down. Here's how we're managing it. Here's how we're thinking of repositioning our portfolio. Here's how we're increasing the value. Here's the way we've changed our investment thesis. Like, I want humans that will hit problems head on with honesty and integrity. And to me, that's like all you've got at the end of the day, man. That's it. So the operator, like, how do I do my due diligence? I see where they came from. If they came from a trusted source, then great. It's a lot easier. If they didn't, I want to see their financials. I want to see their underwriting. I want to look at the loan documents. Like, I want to ask to see under the hood completely. And if they start getting tight around things, that's usually a red flag that something's not what they told me it was going to be. If they only will show me their model in PDF and they won't send me the Excel format, probably means formulas are hard-coded because either A, they don't know how to make the formula do what they want it to do, or B, they're making the formula show me numbers I want, not show me numbers that I should have. And an example of that is one time I asked for the Excel model on a PDF, and the guy sent it to me, and I went into the cells that were calculating the total return quarter by quarter. And when they were doing the cumulative year over year, it was taking the quarters and multiplying it. It's taking one quarter and multiplying it by 4.25. And I was like, why is it multiplying it by 4.25? There's 4 quarters in the year. He's like, oh yeah, well, that's just to manage out this the cyclicalness of the quarters. I'm like, well, you can't put a buffer to your favor to manage out the volatility of the quarters. Like, that doesn't make any sense to me. So it was like showing me that, like, hey, I want to show this number better than what it is in reality, and I'm going to add in a quarter of a quarter to make the numbers look better. Like, red flag number 1, I'm out. And I would have never caught that if I took his PDF thing for Word. Like, if I took the PDF thing for Word, I would have been like, looks like a pretty good deal. So, I ask a lot of questions, and then I see how the human responds. Like, I've had the privilege of talking to you a bunch. Like, you're an honest, transparent, like, open book. Like, let me show you the numbers. Let me show you everything. Let me, like, sure, you want that? Let me get it for you. That to me gives me faith. That to me gives me confidence. But when you talk to somebody and like, hey, sorry, we don't disclose that, or hey, I'm going to need you to sign an NDA, or hey, I'm going to need you to do this. It's like, what are you trying to hide? Like, unless you have the next recipe for Coca-Cola, like, nothing is confidential in this world anymore. Like, everything's on the internet. So like, I don't want to go figure out how to do oil and gas wells. Just send me the model so I can see the numbers. That's it. That's all I want.
Great points. Great points on honesty and trust and really understanding the operator. Also loved, actually just had a discussion the other day about checking PDFs and making sure you get the Excel models and just making, so +1 on
Simple.
that.
It's simple.
And it's kind of just like, this was awesome so far. I would love to just kind of wrap maybe with 1 or more 2 questions. I'd love to understand maybe one of your best or like favorite investments and why that is, or maybe one of your favorite operators and why they're one of your favorite operators.
Yeah, so one of our favorite operators is a guy that focuses on distressed debt, and he's my favorite operator because he always underwrites conservatively and always doesn't assume any juice or upside potential. So when you see the deal and you see it's like a 1.7 multiple, given his track record, given his underwriting, given the deals, it's probably going to be higher, but he doesn't make any assumptions that the juice is going to actually be realized. He assumes like base case, worst case scenario, we're hitting a 1.7x. And so I feel like really confident about that. And the thing I like about that space a lot is it all has collateral value tied to real estate. So that's a real asset that will have some value somewhere. Now, if I bought the real estate asset for $100, maybe I can't sell it for $100, but it's certainly not zero. It's somewhere in between, no matter what happens. Even if there's a fire on the property and the property burns down, the land still has a value. So I know that some of my capital is protected. So like that space is my favorite because you have downside protection, but you're not capped on your upside potential because of just how you can manipulate distressed debt and how you can do different workout scenarios and lever it and all that stuff. So that's probably my favorite space to invest in. I understand it. I understand how you can underwrite real estate. I understand how you can come up with a value. I understand that the borrower is paying us something. Even if they're subperforming, I'm getting some cash flow on my investments. So I really, really like that space. I've always been a fan of that space. Another space that I liked a lot, and I still like it, I just don't think now is a great time, is single family. Like, I think that's an incredible space to invest in, but I just don't know that right now is the right time to buy single family homes. Now, if you're doing land and you're doing stuff with publicly traded and large regional builders, like, that's really interesting to me, because again, you have a value, that land has value. If you can structure the deals in the right way, you can have the end buyer, the builder, paying you some sort of an option fee or a current pay component to have the rights to that land in the future. And so to me, that space is super attractive. So you'll hear like the same sort of narrative echo through it. I want to protect my downside and make sure that I can't lose all my money. I don't want to cap my ups, but I want some cash flow along the way. That's sort of like my MO.
That was awesome, Matt. Thank you so much for joining us on the show. And if anyone wants to reach out to you, how best can they do that?
Yeah, I think the best way would just be go through GoBundance or just Facebook or Instagram or whatever. I'm not a huge social media website or something guru. I'm just pretty simple. And if I can be of service, I'll give you my email to throw in the show notes. If I can be of service, feel free to reach out. But my last piece of parting advice to everybody would just be like, pay attention to fee structures associated with deals, pay attention to the leverage assumptions associated with deals, and ask a bunch of questions and ask for references always. Like, always ask for references. Even if you don't call them, at least get a list of people that you could call that person told you has invested with them before, so you can at least do some sort of checking on the deal itself and make sure you're not getting into the next Bernie Madoff Ponzi scheme.
Love it. Love it. Thank you again for hopping on the show, Matt. And thank you everyone for tuning in.
Thank you, man. Appreciate it.